Hey everyone, good morning.
Good morning.
I think we have low
Good morning.
participation today, so just giving it one more minute to see if others are able to join and then we can get started.
Good morning, Gaurav. By that time, I had a doubt and I'm not added to the Telegram group yet. So, can I ask you from yesterday's session?
Yeah, we can keep those questions till the end, Shivani, if you don't mind, and then we can definitely answer that.
Sure. Thank you so much.
All right, in the interest of time, I think we can get started. Um, I hope everyone's gone back and studied the material from Fast Forward. Um, as we discussed yesterday, we will be going over some questions live, so that we can uh, utilize this 10-15 minutes at the start of the session as a refresher, and then we'll dive deep into business taxation part one. So we'll be going over those concepts in detail today. With that, let me just open up the Fast Forward Academy portal.
Yes, it's visible now.
Yes, we can see your screen.
Okay, awesome. Um,
Gaurav, could you also share in the chat the link for the Fast Forward Academy login?
yes, for sure. All right. So at the moment, you don't really need to log in. But just wanted to make sure that we have some refresher for yesterday's session. I didn't want to really go through the slide deck again. I thought it would be helpful to solve some multiple choice questions on this group live. So I've selected about 15 questions from the bunch that we had, and we'll go over those. I would request everyone to put in your answers in the chat box. So that would be helpful, to not interrupt the session, and then we can discuss why each option that we selected is correct and why the rest are incorrect. I see Chirag has a question that he was not able to attend the class yesterday. That's totally fine, Chirag. You can utilize the recorded session to, go back and view it. And then, this hopefully the first 15 minutes will serve as an overview for you based on the yesterday's class. All right, so the first question says Abraham becomes an equal partner in the KitKat and Kit partnership in 2012. In 2011, he filed his personal tax return on the calendar year tax basis. The partnership reports income and expenses on the fiscal tax year basis. How should Abraham report partnership income or loss distributed to him? The first option says that he may choose a fiscal year to report income and expenses. Second one says that he must report income and expenses on calendar year basis. Third one says he may choose either of it. And the last one says that Abraham may choose a fiscal tax year and then later obtain IRS approval. What do you guys think is the right answer? I see answers have started to come in. Some are saying B, some are saying D. I also see some are saying C as well. Okay, the right answer is that he must report income and expenses on the calendar year basis. Again, the logic behind that is that he didn't really change his tax year, right? He did not request for a change in his accounting period, so it would still remain that Abraham files his return on calendar year basis. It does not really matter uh, what tax year or what accounting period the other entity is following. So from an Abraham perspective, he will still report income and expenses on calendar year basis. If anyone has any, questions or clarification on the options that we are going over, you can just unmute and talk. But otherwise, I'll just keep moving forward.
Sir, I have one question. What is difference between calendar year and financial year? So, could you please?
Sure. Did you attend yesterday's class?
Yes, but I missed some point there.
Okay, so calendar year is basically your regular January 1st to December 31st period, and fiscal year would be any 12-month period apart from calendar year. So it could be, July 1st to June 30th. It could be April 1st to March 31st, any 12-month period apart from the regular calendar year.
Okay.
Yeah. All right. So the next question says, after the calendar year is over, an employer must furnish a copy of Form W-2 to whom? Again, in any multiple choice questions, you have to read the question twice, because the trick lies in the question. It is more about reading the question accurately so that you can get to the right answer. So the options are IRS, subcontractors who earn more than $600, each employee who earned wages during the year, or state tax authorities. I see mostly everyone says C, and let's see if that's the right answer. Bingo.
Gaurav, it is just like we receive Form 16, na?
Yes, exactly. Um, so the W-2 is, similar to what we receive in India as Form 16 from our employer. So each employer is required to furnish W-2 to the employees for the wages or salaries earned during the year. Now, some people might argue that IRS is the right answer. It's not accurate because, like I mentioned yesterday on the slide deck, W-2 is filed with Social Security Administration, SSA, and not the IRS. So we don't really see SSA in the option choice. So that's why employee is the right answer here.
Gaurav, I think you are in individuals, not in business taxation.
Yeah, but the multiple choice that I'm choosing is for business. Don't worry about that.
So sir, what if there is option in SSA also and each employee also?
There will not be such cases. Usually, if you have cases where employee and SSA is listed, you will have another option that says both A and B or both A and C, something like that. There will definitely be clarity around that. All right, we went through this yesterday. I hope everyone remembers all of the informational returns that was listed out in a table format. So which of the following is not an informational return? What do you think is the right answer? Right, I see most of them say Form 1120. Can someone highlight why 1120 is not an informational return?
Gaurav.
Yeah, go ahead, Anil.
So 1120 is a corporation return wherein a corporation is just have to pay tax rate at the rate of 20%, but other 1120S or 1065 they are informational returns because all the income or losses are just passed on to the investors like partners or shareholders.
Yeah, that's accurate. And I see most of them agree with that it is a return where you pay taxes. It's not just informational return like the rest of, the option choices that we have: W-2, 1098, 1099B. All of these are informational returns, whereas 1120 is actually a tax return where you pay taxes. So that's accurate. All right, this one's a little tricky. I hope everyone's able to get this correct. So Donna Lee is a salesperson employed on a full-time basis by Bob Blue, an auto dealer. She works 6 days a week and is on duty in Bob's showroom on certain days assigned days and time. She appraises trade-ins, but her appraisals are subject to sales manager's approval. List of prospective customers being belong to the dealer. She is required to develop leads and report results to the sales manager. Because of her experience, she requires only minimal assistance in closing and financing sales and in other phases of her work. She is paid a commission and is eligible for prizes and bonus offered by Bob. Bob also pays the cost of health insurance and group term life insurance for Donna. What is the employment status for Donna? I see some are saying she's a statutory employee, while some others say that she's a regular employee. That's option D. Are there any other choices that we see? Some are saying statutory non-employee as well. Okay, so the right answer is that she is an employee, a regular employee. Now, That is also because, if you look at the three factors that we spoke about, the behavioral, financial control, you see that Bob manages her finances. Obviously, he is paying the salary, so he is having financial control over Donna Lee. He also has behavioral control. Although she requires only minimal assistance, it does not prove otherwise that she might be an independent contractor or a statutory employee. It's a regular scenario where we see an employer employee relationship. It is a regular job that she is performing, so she is a regular common law employee. So common law employee, or option D, just an employee, is the right answer.
What's the difference between a statutory employee and an employee on common grounds?
So statutory employee is not like a regular employer employee relationship. They do not have full control over the day in and day out of the employee. And if you look at some of the option here and go back to the textbook, it has listed down what four categories constitute statutory employee. It can be a commission agent who delivers food, laundry, dry cleaning services, a full-time life insurance agent, and then there are some other examples that are given. So only these four specific examples form a statutory employee. And again, statutory employee are not subject to income tax withholding by their employer, whereas a common law employee would be.
Yeah, thank you.
No problem. Okay, this again is a tricky one, so please pay close attention. It says Steve Smith, a computer programmer, was laid off when the Megabyte company downsized. Megabyte agreed to pay Steve Smith a flat amount to complete a one-time project to create a certain product. It is not clear how long it will take to complete the project, and Steve Smith is not guaranteed any minimum payment for the hours spent on the program. Megabyte provides Steve Smith with no instructions beyond the specifications for the product itself. Steve and Megabyte have a written contract which provides that Steve Smith is considered to be an independent contractor, is required to pay federal and state taxes, and receives no benefits from Megabyte. Megabyte will file Form 1099 NEC, non-employee compensation, to report the amount paid to Steve Smith. Steve Smith works at home and is not expected or allowed to attend meetings of the software development group. What is Steve Smith? Is he a regular employee? Is he a temporary employee? Is he a part-time employee or an independent contractor? Okay, see, I see most of them are very confident that it is option D, an independent contractor. Some probably feel that he's a part-time employee. All right. So one tricky thing that I wanted to highlight here. You might see this on the exam. Yesterday we went through 4 different types of employees, right? Can someone highlight that? Does anyone remember the different 4 types of employees that we went over yesterday?
Non-statutory employee, statutory employee,
Common law.
and regular
Independent
employee,
contractor.
independent contractor.
Yes.
Yeah. Yes. So it is common law employee or a regular employee. Then it is statutory employee, and then non-statutory employee, and then you have your independent contractor. So one tricky thing, if you notice, is that they have given options such as temporary employee, part-time employee, and then regular employee. All these 3 things still mean the same, because either if you're working in full-time or part-time, it does not really matter. If you're treated as a common law employee, you would still be falling under those requirements from a withholding and reporting standpoint. So again, that would strike out all these 3 options for you if you establish that they don't have an employer-employee relationship. And that's why I see most of them did answer independent contractor, which is absolutely correct. Okay, next one again on the employee status. So Tom Spruce rents a cab from the Taft Cab Company for $150 per day. He pays the cost of maintaining and operating the cab. Tom Spruce keeps all fares that he receives from customers. Um, Although he receives the benefit of TAP's two-way radio communication equipment, dispatcher, and advertising, these items benefit both Taft and Tom Spruce. What is the employment status for Tom? So I see there are mixed responses this time.
So what is the meaning of here in a two-way radio communication independent dispatcher? Like,
These are technical equipments. Two-way radio communication is basically a walkie-talkie. Um, Dispatcher,
okay,
I'm not really sure, but again, we don't really have to get into the specifics. All you have to understand is that all of these equipments are provided by um, Taft Cab Company.
Hello,
Yeah, go ahead.
I have a one queries.
Yeah, go ahead.
Actually, this is my first joining of today's session. So can you give a brief detail which topic is going on like that? Then
So
it will be
this is a
yes.
refresher session from yesterday's class, Papia.
Okay.
So I would request that you go back and listen to the recorded lectures, and that would be helpful because again, we are not able to give an overview of yesterday's class in this session.
Okay. So today's topic is not yet started, right?
Not yet, yes.
Okay. Okay, sir.
All right, so there are mixed responses in this one. Let's see what the right status is. I would go with option B, which is what most of them have answered, and it seems to be incorrect. So if you read through the explanation, it says to determine whether an individual is an employee or an independent contractor under the common law, the relationship of worker and the person paying for his performance must be examined, right? And if an employer can control what will be done and how it will be done, it's a regular common law employee. That's what I was saying. If you have behavioral control, financial control, all of those can be established, then it's a regular employer-employee relationship. Can everyone mute their mics, please? Right, thank you. So in this case, if you notice, the Taft company, although they do provide a lot of the equipments, they don't really have full control over what Tom Spruce does, right? He just hires and rents a cab from them for $150 a day. They do provide some equipments, but it is up to Tom on what he does. It's a regular Uber and driver relationship. So in this case, they're considered to be an independent contractor. All right, quickly moving over to the next question. J&J each own 50% of J&J Partnership, which was founded 20 years ago. J&J is a calendar year taxpayer. On March 15, 2012, they elected to be treated as corporation for federal tax purposes by filing Form 8832. What is the earliest date that J&J can be treated as corporation without regard to the election relief rules? Can someone throw light on what is Form 8832?
I think it is an election wherein which we file with IRS that to just consider the status as a corporation.
So LLCs by default are treated to be partnerships, right? Like I
Right.
mentioned yesterday, LLCs are defaulted to be partnership. If you check the box, if you check the box election on Form 8832, then you can be treated as an corporation. LLCs can be treated as corporation if you do the check the box election. So Form 8832 is check the box election form. So again, it says, what is the earliest day that J&J can be treated as corporation? The right answer is January 1st, 2012. And that is because when I said yesterday, they have 2.5 months to make the election similar to an S Corp. It is the same case for LLC. The retroactive effect takes place. So if you made the election this year, say on March 15th, then you can be considered a corporation right from the beginning of the year, which is January 1st. So January 1st, 2012 would be the right answer in this case.
In this case, January 1st, they just considered themselves as a corporation, and within it, after 2.5 months time frame, March 15th, they filed their election. right?
Yeah, it becomes a retroactive election. So
Yeah.
it goes back to the start of the year that you can be considered a corporation.
What
Okay.
happens if it's after March 15th?
So if it happens after March 15, then it would not be retroactive unless an exception is provided by the IRS. In some cases, if you do write a written response to the IRS, they might consider if there's due cause, right? There might be instances where you might have failed to file the election on time. So certain exceptions are taken into consideration on a case by case basis. But if you don't make the election on time within 2.5 months from the start of your taxable year, then you're not considered to be uh, corporation for that year.
But then it'll start from next year, right?
Yes, correct.
Gotcha.
Gaurav, could you please explain the seventh question again?
Okay, let's go back. So
Yes.
here J&J each own 50% of J&J partnership, right? Which was founded 20 years ago. Now J&J is a regular partnership. They didn't really mention LLC here, but the trick lies in Form 8832. So if you remember, Form 8832 is for LLCs to be to be treated as a corporation, right? By default, LLCs are partnerships. Now, if they want to be converted into a corporation, they have to file Form 8832. So that's what J&J did on March 15, 2012. And the question is asking, what is the earliest date that J&J can be treated as corporation? So you have to remember that if they made their election within 2.5 months from the beginning of the tax year, which in this case would be January 1st because they are a calendar year payer, then it would be retroactive election in effect. So since they filed it on March 15th, which is on time, the retroactive election takes effect and they would be considered a corporation right from January 1st onwards.
Okay, so they can elect themselves from January 1st to March 15th whenever they want to, right?
Yes, correct.
Thank you so much.
No
Could you
problem.
please explain what is election relief?
Without regard to the election, yeah, that's what I was talking about. If you intended to file late, sometimes it does happen that you might get late and not file within 2.5 months. So there are case by case basis where IRS takes into consideration these election relief rules, and you don't really have to get into those details, but there might be certain cases where even if you file late, you can be considered a corporation for that year as long as IRS approves it.
Sir, I didn't understand these questions. So what is the purpose? Why it is been treated as 1st January 12? So what is the basic purpose? Could
So
you
again,
please?
again, just like I mentioned, if you do file the election within 2.5 months from the beginning of the tax year. So in this case, since it's a calendar year payer, what is the beginning of your tax year? January 1st, right?
January 1st, yes.
Yeah. So they did file the election within 2.5 months from January 1st. Then in that case, right from January 1st onwards, you can be treated as a corporation. It is as simple as that. You just have to remember, if they make the election within 2.5 months from the beginning of the tax year, you can be treated as corporation for that entire tax year. Does that clarify?
Yeah. If they elect April 15th, then it will be on Feb 1st.
No, it goes back to the beginning of the tax year. Again, I'm saying that it is right from January 1st. Why are you thinking about the first date of the month? Right? For a
No,
calendar year
if
taxpayer, what is the beginning of the tax year? It is January 1st.
okay, so January 1st
Is when the election would take effect.
only January 1st.
Yes,
Okay.
correct.
Hi Gaurav, Raman this side. I have a quick question.
Mhm.
So the maximum time period to elect is 2.5 months, right?
Yes.
Okay. Thank you so much for answering. This is my first class. I just wanted to clarify. Thanks.
No worries. Okay. All right. So quickly moving on to the next question. Paul is employed by his spouse, Jasmine, in her flower shop. Paul's wages are subject to what type of tax? We went through this. When when you employ your spouse or your parent in your firm, what are they subject to? And there's one type of tax that they're not subject to. I think I gave up the answer, but let's see what the audience says. All right, most of them say A, which is the right answer. So if you employ your spouse or parent in your firm, whether it is a sole proprietorship, partnership, doesn't really matter, then their wages are subject to income tax and FICA, but it is not subject to the unemployment taxes. So this is something that is factual. You just have to remember this for the exam purposes. All right, the next question says, which of the following taxes is an employer not required to withhold from his statutory employee's wages? There is one type of tax I mentioned, just a few minutes back, that they are not required to withhold from a statutory employee's wages. What do you guys think is the right answer? Seems like there are mixed responses, but most of them say income tax, which is absolutely correct. Both Social Security and Medicare have to be withheld from a statutory employee, but income tax is not supposed to be withheld upon. Income tax is only withheld from a regular employee or a common law employee. All right. I think we'll just take this one last question in the interest of time because we have spent almost half an hour here. So which of the following entity classification is available for a newly formed single member domestic LLC? Read through the question very carefully and the answer choices. This is a little bit tricky question, I would say. So it's asking what entity classifications are available for a newly formed SMLLC. Some say A, some say D, some are also saying B. And the right answer is B, which I think just Gaurav answered, but B is the right answer. It can be either treated as disregarded entity or a corporation. Now, the argument here is that a single member LLC or an SM LLC by default is treated to be disregarded for federal tax purposes. So it is a disregarded entity, but it also has check the box election, right? We spoke about it, Form 8832. So if it files Form 8832, then it can be treated as a corporation as well. In corporation, you don't really have any minimum member limit, right? Even one person can be owning the entire corporation. So it can be either a disregarded entity or a corporation. All right, I think we
Gaurav,
will.
just like in case of a GP, I mean, wherein because in most of the cases, in the regular tax returns, we see the GPs are the DREs. I think single member LLC, these are. That's why I think.
No, you don't have to confuse between partnership because partnership GP comes into picture only in a partnership, right? We are only talking
Yeah.
about what entity classifications are available for a SMLLC. Now, SMLLCs by default are disregarded for tax purposes. They don't have an entity status for federal tax purposes again. Now, if they do file Form 8832, which is check the box election, then they can be treated as a corporation. That's all the question is asking about.
Right. Thank you.
Yeah. All right. I think hope this refresher was a bit helpful. You guys can let me know if we should continue such refresher sessions in the future. I can adjust to your style if you guys want to skip this and go back and solve answers on your own. We could do that as well. But I think spending like 15-30 minutes on just refreshing concepts the day before would be helpful.
Yes, it is very helpful because in case of any confusion, at least we can ask you, sir.
Okay, all right. If you guys want, we will go through the 5 questions that we, skipped here at the end of the session if we do have time, but I'll quickly switch over to the slide deck for now.
Sure.
And I see most of them do want these sessions to be continued, so let's do that. All right, are you able to see my screen?
Yes.
Yeah.
Okay, perfect. So, um, business taxation again is a vast concept. So I split that into two sessions. Today we'll be covering few topics which relate to uniform capitalization. We'll be talking about inventory, the different inventory valuation methods. We'll also be looking at what is employee compensation, what can be taxable, what is not taxable, what can be excluded from taxable income. So we'll be looking at those specifics. Then we will also be talking about what are the different expenses and deductions available to a business, right? What expenses and deductions can be claimed by the businesses on their tax returns and what is not allowed from an IRS perspective. And then like yesterday, I would request everyone, to park all of their questions in the chat box or at the end of the session. Let's not interrupt the class while we talk about, the topics. Okay, with that, the first topic for the day is uniform capitalization rules. Now, these are popularly also called as UNICAP in short. So these are tax regulations which are established by the Internal Revenue Service or the IRS, that require businesses to capitalize certain costs which are associated either with the production of goods or the acquisition of property. So essentially, when we think about expenditures that a business makes, we usually want to report that on the profit and loss statement or the income and loss statement, right? But IRS says that if you fall under this UNICAP rules, then it tells you how to handle these costs when they make the things, that is produce things, or when they buy stuff to sell it, when they are reselling the stuff. So in those cases, you will have to capitalize it, that is added to the cost of the asset, right? Which is also called basis. Now, what are direct and indirect costs? Direct cost, imagine you're making wooden chairs, right? The wood that you use, the nails, the paint that you buy to paint the wooden chairs, all of that are direct costs because they are directly used in making the chairs, right? When you talk about indirect costs, now in the same example of making wooden chairs, think about hammers that you would have bought, the saws that you would have bought to cut the wood. Now, these hammer saws that you bought not necessarily would be, just used for making chairs. It could be also used to make, tables or some other type of furniture. So, but there is some use of those tools in the making of chairs, right? Even electricity, for that example, electricity that is used in the workshop might be somewhere used to make the chairs, but not necessarily entirely. So these are some indirect costs. You'll have to find a way to allocate these indirect costs as well to the asset. So just a big differentiation between a direct and indirect cost. Now, what does this uniform capitalization rules apply to, right? Um, it primarily applies to businesses that are engaged in the production, purchase, or improvement of property for resale. So one key thing to remember is if you're producing goods, right? In those cases, UNICAP comes into picture. It also comes into picture if you are buying property to resell and if you make certain major adjustments to that property, right? So if you just buy it to resell and if you haven't altered the structure of the inventory for that matter, then it does not fall under UNICAP because you haven't really done anything to the um, inventory, right? If you alter it and improve the inventory, right? If you buy some raw material and if you refine it in certain way, if you make major adjustments to that raw material and then if you sell it, then you still have to follow UNICAP rules. So that's one key thing to remember. It mainly applies to manufacturers and producers, like I mentioned. It also applies to construction contractors. So any builders have to follow these UNICAP rules. Then again, like I mentioned, resellers who make substantial alteration, right? That purchase goods for resale and then substantially alter them before they are sold, they are also subject to UNICAP rules. Agricultural producers, people who buy or grow, raise crops, livestock, poultry, any agricultural products for sale, all of these have to still follow UNICAP rules. And certain service providers with tangible property, right? These could be tangible personal property, could be films, recordings, videotapes, all of these big production companies that you have, all of these folks also have to follow UNICAP rules. Now, when we look at what it applies to, we also have to look at certain industries or certain taxpayers that it does not apply to, right? So usually it does not apply to all types of businesses. There are some situations where UNICAP may not apply to. It does not apply to small business taxpayers. Now, if you guys remember, yesterday we spoke about small business taxpayer exception, right? What can someone remind me? What's the threshold for a small business taxpayer?
29 million.
Yes, that's accurate, right? So if your average annual gross receipts for the last 3 years was less than 29 million, right, then you fall under small business taxpayer exception, right? If you fall under small business taxpayer exception, then UNICAP rules would not apply to you. It also does not apply to retailers and wholesalers. Now, specifically, these retailers and wholesalers are those that do not alter the inventory. They're just buying it from someone and reselling it. So it does not apply to them because they haven't altered or made any adjustments to the byproduct. It also does not apply to service providers. All of these accounting firms is a service provider. Simandhar is a service provider, so it does not apply to them. It does not apply to non-manufacturers again. And certain expenses also do not have to follow UNICAP rules, like your marketing expenses, your selling expenses that are incurred after the good is ready for sale, because it's again, post the production of your goods. R&D, research and development expenses, which are covered under Section 174, those expenses do not have to be capitalized. Interest expenses, now certain interest expenses do not have to follow UNICAP, but there are certain other that do have to follow UNICAP. As long as it's related to the production of the asset, then it has to be capitalized. But your regular interest income that regular interest expense that you have to pay in terms of borrowing the debt, all of those do not have to be capitalized. They are a direct cost which goes to your P&L statement.
Suppose if we borrow for that product only, that interest will be considered as direct cost?
Yes, it has to be capitalized. That's accurate.
Okay.
So can we say that the UNICAP rule is basically formed to applicable to only the manufacturing sector industry, not any other, right, sir?
Yeah, on a broad scale, again, like I said, it's mostly for manufacturers and producers, your construction contractors. It can also be for some agricultural producers as well. So
Okay.
these three categories is majorly that you would see on the exam. Again, they could have answer choices which say that, UNICAP does not apply to the following except,
Yes.
So
Okay.
you have to remember that mostly it applies to manufacturers, construction contractors, agricultural producers, and then certain service providers with tangible personal property. That is your artwork, your videotapes, books, photographs. All of these do fall under UNICAP.
Okay. Thank you, sir.
As you have told that the R&D expenses, selling expenses, it would not be under this category. Okay. So my question is, what about advertisement expenses?
Advertisement is again marketing expenditures, though that would still not be under UNICAP because it's after the production of the good that you would advertise, right? So it does not
Yes.
fall under UNICAP.
Okay.
Find a way to remove this. Okay, so continuing on.
We missed the previous slide.
Yeah. So inventory is the next topic. Again, can everyone mute their mics, please? Okay, thank you. Okay, so inventory from the perspective, I know we've all studied about inventory, different methods of inventory. It could be either commerce classes, accounting classes. So inventory basically refers to goods and materials that are held by a business. It could be purpose for resale. It could also be used in the production of goods as well. Now, inventory can be broadly classified into three things. It is your raw materials, work in progress, and finished goods. All these three combined together forms your inventory, right? From an EA exam perspective, the major things that can be covered on the exam are the different inventory valuation methods or specifically, how do you calculate cost of goods sold? That is one major thing that you would see on the exam. So we'll just focus on that for this session. From inventory valuation methods perspective, I know most of you would have heard about these FIFO and LIFO. First in, first out is your FIFO method,
Last,
which,
last in, first out.
yeah. Um, so first in, first out FIFO is basically, when you assume that first inventory purchased are the first ones sold, right? The first inventory that you purchase are the first ones that are going out. So that is your FIFO method, and LIFO is exactly the opposite. That the last ones you purchased are the first ones that are sold. So again, they have their own benefits from a financial standpoint and accounting standpoint. We'll not dive deep into it, but just remembering what are the different inventory valuation methods is more than sufficient for the exam. Papia, can you please mute yourself? Yeah.
What is
Uh,
specific indication here in?
Anil, can we park the questions and the end because it's really
Okay,
interrupting the flow of the
sure.
session? Yeah, thank you. So the next two inventory valuation methods are weighted average cost and specific identification. Specific identification method, or weighted average cost for that matter, is where you calculate the average cost of all units available for a sale during a specific period, right? You would take the weighted average cost of different inventory that were available. Say in January, you might have a set of inventory. In June, you might have another set of inventory. And in December, you might have another set of inventory. So you would take the weighted average cost for all those three. The purchase cost might be different for all the three inventory that we bought, right? In January, June, and December, it might be at different purchase price. So you would take the weighted average cost and divide by the cost of goods available for sale. Again, there is a formula to calculate cost of goods available for sale. It falls under financial accounting. It's not relevant to enrolled agent. So we are not getting into the specifics of how do you calculate it, but just remembering that when you do a weighted average method, um, it's a blended cost per unit. So that is what is used for weighted average cost per purposes. Again, there are specific industries that are required to follow this. We don't really have to worry about which industry to follow this. You specifically have to remember that there are four different inventory valuation methods: FIFO, LIFO, weighted average cost, and specific identification. If you talk about specific identification, in this case, what happens is, um, if you assign the actual cost of each inventory that you have bought to specific units, right? It usually happens in low volume industry where you're able to differentiate or identify specific products. If you have high volume, mostly in like food products and all of that, you cannot specifically identify costs, right? It's usually in small volume industry with large turnovers where you can specifically identify and assign those costs. Um, it can, it, and best example for specific identification would be in the production of diamonds, right? When you do diamonds, when you manufacture diamonds and refine it, reshape it, or whatever you do it, you're specifically able to identify the cost involved in manufacturing that diamond because it's such a high value item that you don't have to worry about the different methods, whether it was a FIFO, LIFO, or weighted average cost. So it's usually used in such high value industries where specific identification is more apt. Again, the choice of inventory valuation method can have significant impact on their financial statements, tax liabilities. Obviously, it depends on what method they're using. They do take into consideration which industry they fall under. What are the tax regulations? What is the inventory turnover? If the inventory turnover is very low, they would be probably using specific identification as opposed to FIFO or LIFO, and the other way around, right? So it all depends on what industry you fall under, what are the tax regulations. So different businesses would choose different valuation methods. There's obviously pros and cons to each. From an exam perspective, again, specifically, cost method is something that would be focused on. And you would see questions like, what is the cost of goods sold based on certain facts and figures? Now, you'll have to remember two main things. One is the formula to calculate cost of goods sold, and the other is what constitutes inventory, right? The formula is given right on the slide deck. Your cost of goods sold is equal to your beginning inventory, which is BI, plus your purchases plus any other direct costs that are associated with the production of goods, right? Only with the production of goods minus your ending inventory is equal to your cost of goods sold. This is a very simple formula. Now this can be tweaked based on, instances where you don't have direct cost or you might have certain additional items. But just remembering what is cost of goods sold, beginning inventory plus purchases plus other direct costs minus your ending inventory is your cost of goods sold, right? The other item to remember is what constitutes inventory, right? We spoke about it. Three things that constitutes inventory is your raw materials, your work in progress, and your finished goods. So you might have your beginning raw materials, beginning work in progress, beginning finished goods, and similarly you might have ending values for those three. So all of those put together is your inventory, right? It's not just one or the other. All three put together is your inventory. So I have a specific example that I wanted to highlight. You might see something like this on the exam, maybe smaller facts and figures, but I try to incorporate majority of the items that you might see on the exam. So here's an example we'll solve together. So it says that at the beginning of the accounting period, the store has 15,000 worth of inventory, and maybe we could do it live in an Excel. Um, all right, so we have a formula we know, right? Beginning inventory plus you would add what? What's the next item to add?
Purchases.
Right. What other thing do you add to
Direct
purchases?
cost.
Debtors.
Other direct costs.
Costs of production.
Direct costs, right? Direct
Minus
cost of
closing
production
stock.
Less ending inventory.
minus ending inventory. Right. So we know our formula very clearly. Now let's look at the facts and figures. So it says the beginning inventory of the accounting period, the store has 15,000 worth of inventory. So I would add 15,000 as my beginning inventory. For purchases, it says that the store purchased 30,000 worth of new inventory, including 1,000 in freight costs. So how much should I add as purchases here?
29,000.
16.
30, so
29,000.
No,
no,
31,000.
it is include 1,000 is already included in
1,000.
30,000.
1,000
Yeah.
I think is direct cost.
Yeah,
So
it is direct
again,
cost.
let me clarify that. So when it says the store purchased 30,000 worth of new inventory, it is also saying that this includes 1,000 in freight cost. Now this is
Okay,
just
then
to,
30,000.
yeah, it is just to trick you guys on the exam. Now this 1,000 is obviously a direct cost when purchasing this inventory, right? So it would be the entire 30,000 that would be added as purchases. The next thing that says is the store incurred 5,000 in salaries for employees involved in receiving and stocking inventory. Should we add this?
No, the store. What is? Can you repeat it?
Yes, sir.
So employees who were involved in, maintaining the inventory, stocking the inventory in the position, they were paid 5,000 in salaries. Should we add those
No,
salaries
this
or
one is
We
wages?
need to
indirect
deduct.
cost.
No,
We need to
Direct.
deduct.
Directly allocated to inventory, so it should be added.
It should
Yes, that is accurate. So since it is directly allocable to inventory, this can be a direct cost that is incurred in the production of goods. So this should be added as a direct
Yes.
cost for production. If in case these salaries were incurred by say admin staff or marketing staff, right, or finance staff, then it should not be added because it cannot be directly allocated to production. But here specifically, they've mentioned that it is for employees who are involved in maintaining the inventory. So it is a direct allocable cost.
Okay.
Let's see next thing. The store pays 1,500 in utilities and 2,000 in rent for the space where inventory is stored and sold. The store also paid 5,000 for office space. Now, what do you think is a directly allocable cost?
3,000.
1,500 and 2,000 is, yeah, 30, 4,500, I mean, we can
35.
include.
3,500, right? Your 1,500 in
Yeah,
utilities and 2,000 in
th-
rent where
yes.
inventory was stored. Now we know that it is directly allocable to the inventory because it's not used for any other purpose. Whereas this office space could be used for multiple things, so
Indirect
it's not
cost.
directly allocable. So only the 1,500 plus your 2000 should be added here. So your 3500 is added here. Let's see the next thing. Insurance and depreciation. The store pays 500 for insurance covering inventory and 1200 in depreciation for equipment used in handling inventory.
Only
What do you
500.
think we should do here?
The insurance only included.
Yes.
So again, this,
Both to be included.
yeah, this is a bit tricky. So you're saying insurance should be included here. So what would we do with the insurance? Would we add it or deduct it?
Add it.
Why would
It
we
is an
add it? Because
expense.
it's an expense, right? Here we are
Yes.
all saying a cost that is added to inventory. But if you pay 500 for insurance covering that inventory, then you expensed it out of your inventory cost. So you have to deduct it, not really add it. And then 1200 depreciation should also be deducted because this is directly allocable for the equipment that was used in handling inventory. Again, it was not, this equipment was not used for any other purposes, right? You clearly know from the facts and figures that this is a directly allocable cost or expense, so it has to be deducted.
But both of these are as well a cost for the inventory, right? So why not
Expenses.
subtract?
That has to be included. Okay.
This is a cost, but this is cost in maintaining and securing the inventory. So it would reduce the value of the inventory, right? Think about a diamond that you bought, right? It might be worth $1 million, but if you spend $10,000 in paying insurance to secure that diamond, then the value comes down by $10,000 because you've expensed it, right? It would not be worth 1 million 10,000. It would be worth 9,090,000 now because you spent 10,000 more to secure the value of that diamond.
In case of utilities and rent, that is also expensed out, no?
Which one?
3,500, I mean.
Can you please zoom in?
I mean,
Yeah, one
utilities
sec.
and rent.
So
We
the
will
store
also
pays
reduce.
1,000.
Yeah.
Oh, sorry. Yeah, you were right that it should be the other way around. I think, I don't know who was talking. Papia was talking, I guess. So the 500 and 1,200 should be added and not deducted. I was thinking it about from a P&L standpoint, but from an inventory standpoint, it should definitely be added. You're right.
Because all of these are associated costs.
Yes, you're accurate. Sorry about the confusion. I was thinking about it from a P&L perspective, but you're right that when you're talking about inventory valuation or when you're calculating cost of goods sold, all of the costs should be added to the basis of the asset or the inventory. So here, all of these would be added to the inventory cost.
Yep.
Yeah, sorry for that confusion. Moving on, returns and damages.
Gaurav, can you please explain the purchase
I
point
have a
still
little bit confusions on that.
there on the including of right? Just can you please repeat just time? I'll
Okay,
try
let's
to.
complete the example and then we'll come back to any specifics. Um, I'll move on for now, but I'll come back to the purchases question for sure. So the next one says the store experiences 500 in returns and 300 in damages to inventory during the accounting period. What do you think should we do here?
Should be deducted.
It should be reduced.
Yeah.
Should be
Reduced
reduced.
from
300 should
purchased.
be added.
We need to add it, yeah.
No, so this again, both of this would be reducing the value of the inventory. Now think about it as if returns and damages are similar, right? You don't really have that inventory in your hand now. If you don't have that value of inventory, what would you do? Would you add it as a cost or would you reduce the value of your inventory now?
Reduce the value.
Exactly. Right. So both
The
of these.
the return should be deducted from purchase, right?
Yeah, that's what
That
we are
is
doing,
called
right?
purchase return.
See, either we deduct it from purchase or direct cost. The end result is what we are calculating as cost of goods sold. You don't have to get
No,
into
it would be
specifics.
same. It would be same, but it would be more specific if you deducted it from purchase only. That is called purchase return.
Agreed. I'm not getting into the specifics whether it should be deducted from beginning inventory or purchases. Again, we don't know whether these returns are from the purchase item or from the beginning inventory, right? There's no specific facts given that whether these inventory were based on FIFO method, LIFO method, or weighted average method. So we don't really know which inventory was returned or what was damaged. So all you could do is as simple as subtracting it, because the end result is about calculating cost of goods sold. Again, when you're looking at from an exam perspective, if you delve deep into thinking about whether it is purchases, inventory, you will never be able to get to an answer, right? Because looking at the facts and figures, are you able to identify whether it relates to purchases or beginning inventory? No, right? So
No.
the best thing that we could do is deduct it from the entire inventory or cost of goods sold calculation, right? So if I can just deduct it here, your 500 and 300 would be deducted.
Can you zoom the Excel one?
Is this better?
Yes.
All right. The next thing talks about freight. The store paid 3,000 for freight in on raw material purchases and 4,000 for shipment to customers. What should be added and what should not be?
3,000 should be
3,000
added.
only should be added,
Yes.
not 4,000.
Yes. So freight out is not a inventory item. It is obviously expense to P&L, right? So only 3,000 should be added here. Lastly, it says the ending inventory is valued at $12,000. So we have that as simple as listing it here.
Reduce it, yeah.
Reduce it. So beginning inventory plus your purchases plus all your direct costs that we calculated minus your ending inventory. So this would be your cost of goods sold. All right. So quickly, I will take two questions on this example because I don't want to spend a lot of time here. But quickly, if we have any two questions that is common.
Please explain the purchase thing only. Just by looking at the statement, I'm confusing. Gaurav.
Yeah. So purchases, when it says that the store purchased 30,000 worth of inventory, it also says that 1,000 of that was included as freight costs, right? So when you buy inventory, you would have to pay for the shipment, right? So you paid say $1,000 when you bought some goods from someone. Now that is what is included in this 30,000. Should we include it? It definitely should be included because it is part of your purchasing item. It is not separately spent to, shipping it to customers or the end result. It is about buying the raw material or buying the new inventory. So all this 30,000 should be included as purchases. You should not exclude this 1,000 freight costs. Any other question, guys?
All clear.
Good.
All right, thank you. Can everyone mute themselves, please? Papi, I think you're still unmuted. Okay, thank you. Moving on, the next topic is about employee compensation. Now, this is crucial, obviously, from terms of what could be taxable, what is excluded from your taxable income as compensation. Some common terms to remember is key employee and highly compensated employee. Now, key employee has its own test that needs to be passed to be termed as a key employee. You can't just be working in specific level or specific industry to be termed as key employee. So basically the IRS has laid out three tests. First is your officer test, which basically says that if an employee who is an officer of the company and earns more than $200,000 in pay for the prior year, right, then he is considered as a key employee. That is your first test. And it is one of the tests that you have to pass. You don't have to pass all of these tests. If you pass either of it, then you're termed as a key employee. So again, officer test basically says if you are an officer of the company and if you earn more than $200,000 in the prior year, then you're termed as an officer. What is the 5% ownership test? Basically, an employee who earns more than 5% of the company at any time during the current or the previous year, then you meet the 5% owner test. And it is a similar thing on 1% owner test, except that apart from the 1% ownership, you also have to be receiving more than $150,000 in pay. So some key things to remember, what are these requirements for each of these tests? Obviously, you can go back to your textbook, make sure you memorize these. Uh, but it's as simple as passing either of the three tests, and then you would be termed as a key employee.
What's the pay for 1% owner test?
It is a 1% ownership and receiving more than $150,000 in pay.
You also paid for 5%.
Yeah, 5% ownership basically talks about 5% ownership, whether in the current year or the preceding year.
If they fall in any one of the category, then they can be considered as key employee, right?
Yes, correct. So one thing to remember when I'm talking about current year, preceding year, and this is across the sessions that we will be talking about. So we are talking about tax, right? So you always have to remember that when I say current year, it is current tax year. When I'm talking about prior year, it is preceding tax year. It's not calendar year. It's not any other fiscal year. We're only talking about tax year here. So when I say current year, what is the current tax year that we are working on?
Current tax year is 2024, 1st January 2024, and
No,
previous year.
No, no, no.
2023.
Yes, exactly. When we are talking about it from a US tax perspective, if anyone's asking you about the current tax year that you're working on, it is tax year 2023. It is not tax year 2024 because we have not completed this 2024, right? If you're filing return this March, September based on extension, then you are doing returns for tax year 2023, and the previous year would be tax year 2022. So just keep that in mind when even on the exam, if you're attempting exam this year, the tax current year is tax year 2023 and the previous year is tax year 2022.
So, Gaurav, we can say that income earned in 2023 taxed in 2024. Am I right?
Income earned in tax year 2023, taxed in 2024, but it is still applicable for tax year 2023. I mean, I
Right.
wouldn't confuse with, how we have in terms of the assessment year and, our financial year. It's very different in the US. I would just think about whatever income you've earned in 2023, you're paying taxes for that income.
Like
And
we will be filing
assessment year, and
2023
assessment year
years
is,
in 20.
Sorry, I think your question was not complete.
So I
yes,
think
assessment year is which year?
I think multiple people are talking at once. Can just one person?
Yes, I have one question. Assessment year is which year?
Yeah, they don't have any concept as assessment year, financial year in the US. All they have
Okay.
is your regular, calendar year, fiscal year, and what is your tax year. So for tax year purposes, when I'm talking about current year,
Mm-hmm.
what tax year are we focusing on? It is tax year 2023. If I'm talking
Okay.
about prior, it is tax year 2022.
Okay. The year starting from 1st January 2023 to 31st December 2023 is current tax year, right?
No, again, it can be if they are a fiscal year filer, if they're a calendar year filer. Don't get into those details unless you see that on the exam, right? You might be given specific facts and figures if he's a calendar year taxpayer, if he's a fiscal year taxpayer. So it can depend. But we are focusing on tax year 2023 for testing purposes. So all of these items that I'm talking about, the $200,000 pay in the prior year, 5% ownership in the current year, previous year, only from that testing perspective, I'm talking about tax year 2023.
Okay, okay.
Okay, so moving on, what is highly compensated employee? Again, if either of the tests are met in terms of whether 5% ownership is met or compensation test is met. So what does the 5% ownership test say for a highly compensated employee or HCE, right? It says if the employee owns more than 5% of the company at any time during the year, right? Then he is termed to be a compensation 5% ownership. He meets the 5% ownership test and is termed as highly compensated employee. In terms of the compensation test, if you earn more than $135,000 in the preceding year, which is your tax year 22, then he is termed as a highly compensated employee. So basically, if an employee earned say about $150,000 in tax year 22 and did not meet the ownership test, would he be termed as HCE?
Yes.
Yes, right? Because he meets the compensation test, which is above 135,000, right?
Yes.
If he pass 5% owner test, then which one we have to consider? We consider him as a key employee or highly compensated employee.
Now, a highly compensated employee can also be a key employee, right? Because if you meet the 5% ownership test, you're
Yes.
automatically a key employee as well as highly compensated. They wouldn't really have two option choices on the exam. If they're testing you on key employee, they will either test you
Hmm.
on these three scenarios, that is your officer test, your 5% or 1% ownership test. If they're testing you on HCE, they will ask you about two different scenarios, whether it might be a 5% ownership test or your compensation test. They will they will definitely not overlap the two.
So we can say that if a employee is a key employee, then he at the same time he is also considered as highly compensated employee, right?
It 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 almost
If he
depends on
pass
your
the five
facts.
percent owner test.
Yes. Yeah, it depends on your facts and figures that are given on the exam. Now, it does not necessarily mean that the two should overlap. It can be either of it as well, or it can be both together. You can think about it as a CFO in the organization, right? A CFO will definitely be having a high stake in the company. He might be highly compensated as well. So he might be meeting both the compensation test, ownership test. So he might be both a key employee for the organization as well as a head CE. Again, it might overlap, it might not. You all have to remember the different characteristics or different tests that have to be met. That's it. Okay. So those are the some key common terms to remember. When you look at what are the tests that has to be met for deducting employee pay, and when I'm talking about deducting employee pay, it is on your business tax return, right? So because salaries that you pay and wages that you pay, any bonuses that you pay to your employees is a business expense, right? So what tests have to be met to deduct it on your tax return? There are two tests. One is your reasonableness test, the other is your ordinary and necessary test. So what does the first one say? It says that compensation must be reasonable for services rendered, right? That is your first thing that has to be met. The other one says that it must be ordinary and necessary, right? For business operations, it must be ordinary and necessary that you needed to pay this salary. Now, a good example would be that imagine a small business owner paying $50,000 to his son for certain services rendered, right? But at the same time, in that area, the same services could have been rendered for, say, about $25,000, right? Did it meet both the tests in that case?
Yes.
No, it does not. Although it was ordinary and necessary, right? It was necessary for him to pay those salaries for certain services rendered, but did it meet the reasonableness test? No, because if he would have hired someone else and not his son, then he would have just paid $25,000 and not $50,000, the double the time of what he would have normally paid. So it is not reasonable in the normal scenario, right? So you have to consider this, that if in the normal scenario certain employee is just paid $25,000 for the same services, and if the employee paid more, almost double, then it is definitely not meeting the first test. So it would not be allowed on your tax return as a business expense. Because you can think about it, you might be in the US, you might have your spouse working for you, you might just pay them $200,000 and claim it as a business expense. Would the IRS allow it? No,
No.
right? They're not fools, right? So that's why they have laid out these two tests, that you have to be meeting both these tests, and only then you can deduct that as a business expense on your tax return.
Got that.
Gauravs, there is no proportionate allowance also, like entire expenditure need to be not considered.
No, if he is claiming just 25,000, then it's true, obviously. But if you've claimed 50,000 already and you're issued the W-2, then you've created fraud, right? It's not accurate expense, basically. It's almost similar to how, we stay with our parents and we are probably not paying any rent, but we still claim HRA, right? A lot of people are receiving notices on that, right? It's a fraudulent activity. So it's similar to that.
Got it.
Yeah. So yeah, the next topic is about, we are looking at different aspects of what could be treated as employee compensation, what could be deducted, and what is not, taxable. So the first one says the employee business expense reimbursement. So any reimbursement for business related expenses that you give to your employee should be excluded from taxable income. Say you're working for a company, you went on a business trip, all of the expenses, your airfare, your lodging, everything included. If you claim it as reimbursement from your employer, then that should be excluded as an expense from the tax return. And again, this is from a business perspective. I'm talking about the employer, not the employee. Wages not paid in money. So all of these topics that I'm talking about is also listed in your textbook in very detail. What I tried to do is that on the slide deck, I just highlighted if it should be excluded or if it should be taxable, and any key things to remember for the exam, so that when you revise it, it's easy to just go through these slide decks and look at it very high level. But I would still recommend that you go back and read through the entire text, but this is more for a revision purposes.
However, these kind of expenses will be subtracted from the gross income, right?
Sorry, Shivani, can you repeat your question?
I don't, however, these type of expenses will be subtracted from the gross income.
No, it's not included in taxable income at all.
That's what am I telling is, when we calculate the taxable income, we first subtract all these type of expenses, right?
No, we would not subtract it. But that's what IRS is saying. Although you would do it on your books, right? When you maintain your financial statements, you might be subtracting it as an expense that the company has incurred, because obviously you've shelled out some money. You have to be reporting that in your financial statements, but that cannot be claimed as an expense on your tax return.
Okay. From an
So are you
employer,
understanding the difference? So when you're maintaining your financial statements, say you made 100,000 of income and 10,000 of that was spent as employee reimbursement. Now in your financial statements, you would report your gross income to be 100,000 minus these reimbursement of $10,000 to arrive at $90,000 net profit, right? But when you come into your tax return, you would just report the entire 100,000 as income without any deduction or without any expense, because this cannot be claimed on the tax return.
yes, but that can be claimed by an employer, right?
I'm again talking about it from an employer perspective itself. This is not from an employee perspective. But from an employee perspective, that would be covered in your individual section, whether it is taxable to the employee or not.
Okay, so none of them can claim these business expenses.
Yes, correct. And that is again from a tax purpose. Financial statements, they definitely can do it from, whatever the IFRS standards is and whatever the AICP has issued.
Got that.
I have one doubt. You said it's regarding previous point. You said that there should be reasonableness test. Suppose one pays 50,000 to their relative, but if he claims only 25,000, then it's okay. Means in accounts he pays 50,000, but he claims for the purpose of tax payment,
No,
for the purpose of computing.
that's again inaccurate reporting, right? So you wouldn't pay 50,000 as salaries on your financial statements and issue a W2 for just 25,000 so that you could claim on your tax return. You can't do that.
Okay.
It's similar to maybe your employer saying that, okay, let me pay 25,000 in cash and the rest 25,000 I will deposit in bank for TDS purpose. Is that right?
Okay.
The government will not like it, right? They want entire 50,000 to be paid in bank so that their TDS can be deducted.
Okay.
Yeah.
So could you explain one more another example of business expenses reimbursement from the employer's perspective?
It is as simple as, you taking a business trip when you're employed with someone and they reimbursing you for that money. Now, when they reimburse you for that money because of the trip that you took, they cannot claim it as a business expense on the tax return.
Okay, but any reason why? Because it is a business expenses only. The traveling is only for business, but why
Now,
the
this is issued by the IRS, and these are the rules that are set, right? I mean, we can question why and what about a lot of things, right? It is in Indian taxation also. If you talk about whether why is the tax levied at such a high rate, why don't we have one single tax? Why are we paying income tax and then again paying GST, on the same income, right? Same expenses, then it's twice. We are paying GST plus your income tax. We can question all of that, but these are the policies set by the government. There's nothing that we can do about it, right? So tax is not about questioning why these policies were set, because you are not in the power to determine, what the uh, government was doing at that moment, what the Congress was following. But it is more about understanding what the rules are and how do you apply it for your clients. How do you advise them, on certain scenarios, what could be taxable, what could not be taxable, because your clients might not have an understanding of it. They might consider it to be a regular business expense, but for tax purposes, it might be different.
Okay.
It's like he is spending, but he is also getting the reimbursement.
Yeah,
He
I mean,
means
let's not get
company.
too much into detail of
Uh,
these things, because then we will never be able to complete, part two. We'll only be talking about or having a debate about why it should be included or not included. So let's focus on what are the rules and how do we apply it for tax purposes. All right. So with that, the next thing is wages not paid in money. That is taxable. Compensation paid in cash, other than cash, such as goods or services, is definitely taxable. So, for example, if an employer provides an employee with a company car, right, for both business and personal use, then the value of personal use is considered taxable to the employee because that is not used for business purposes. So in that case, those would be taxable to the employee. Um, The next thing is about moving expenses. Now, this is very crucial thing and might be likely tested on the exam, because previously, moving expenses, qualified moving expenses specifically, qualified moving expenses reimbursed by an employer. Say, suppose you were moving from one city to another city, they would give you relocation expenses, right? That happens in Indian firms as well. So similarly, if that was the case before TCJA, TCJA is Tax Cuts and Jobs Act, which came into picture in 2017. So it was a different act that was levied. A lot of bills were passed. A lot of different rules came into picture for both corporate, partnership, and individual taxation. So when that happened, previously qualified moving expenses were not taxable, right? But now the TCJA has changed it. It is taxable per TCJA from tax year 18 through tax year 25. So until December 31st, 2025, it will be taxable in the hands of the employee. So this will likely be tested on the exam. So again, example would be if an employer reimburses an employee for $3,000 for qualified moving expenses, say he shifted from New York to Chicago, then that would be taxed in the hands of the employee. So the employee would have to be included in his tax return in 1040 return and then pay tax on it. De minimis meals. Now these are very occasional meals that are provided by an employer. It's mostly for employee convenience. And this can be excluded from taxable income. The employee does not have to include it in his taxable income. And main criteria for that is that it has to be a very minimal value, and it does not have to be frequent meals that the company is providing. Say your company is providing you lunch every day to come into the office. So, because a lot of companies are talking about return to office, right? So if such meals are provided, then it is definitely taxable. But if it is just a busy season dinner that happens, they just organize some busy season pizza, they're giving you some, cakes or something for that matter, small meals, very infrequent, then that can be excluded from your taxable income. Next thing is about meals on business premises. Again, like I spoke about, return to office. A lot of companies are providing lunch at the office. That is very frequent in nature, and it is on business premises, right? Those kind of meals are excluded. And again, it has to be for the employer's convenience, maybe excluded from taxable income. If it is, say, example, manufacturing company provides, daily lunches to employees working in the factory, then that can be excluded. Lodging on business premises.
Excuse me, I have one question. That
Mhm.
should be excluded from employee point of view, right?
Yes, employee point of view. Again, some of these are overlapping from an employer perspective and employee perspective. But again, like you mentioned, meals on business premises should be excluded from employees' taxable income.
But excluded from employer's taxable income means he can claim the expense, right?
He can claim an expense on his tax return. Employer can claim, but employee has to
Ah,
include it on his income tax return as an income. Sorry,
because
excluded from his.
we are studying for employer deductions and everything. So
Yeah,
it
so
should be
on this portion, when we are talking about employee compensation, some of the topics overlap between individual taxation, and the testing can also be on what is the impact from an employee perspective, right? From an individual perspective. All right. So the next one is about meals on business premises. We spoke about lodging on business premises. Similarly, you can exclude it from the employee's taxable income. Health insurance plans, right? A lot of companies provide tax advantage savings account that allows employees to save some money, right? It's very similar to medical insurance, but it is basically you contribute certain money to an account where that money can be utilized for health purposes. It could be your regular health checkups, it could be due to some emergency or whatever. That amount is tax free. Basically, if you offer that plan, it is tax free and it is excluded from the employee's taxable income. And similarly, you in recently we have seen that there was an act that was launched, which is ACA, Affordable Care Act. In that, health coverage for children of employees under the age of 27. So if you are an employee and if you have a child who is under the age of 27, and if your employer is providing any health coverage for your children, now that is also tax free to the employee. Previously it was taxed, now it is tax free.
Is the insurance is done by the company or the insurance is done by privately?
So that's what I mentioned. The company is providing insurance for the benefit of the employee's children.
Okay. No. If an employee is get wants to get an advantage of the medical claim from his own, then only it becomes a taxable income.
Sorry, I don't think I understood your question, but if I can
If
repeat
an employee
myself,
wants to do it from own,
yeah,
there
that
might
is,
be two options.
yeah, the
One,
employee
the
can
company is
obviously
paid.
do it on his own privately as well, but we are not talking about individual taxation here, right? I'm not talking about what can be done for medical insurance, whether there is a similar deduction available in the US. I'm only talking about if the employer provides insurance coverage for the children of employees or for the employee himself, then that is tax free to the employee, right?
Okay,
Just
so
to
you are
talk
talking
about it
about
from an
the
employer perspective. Let's not talk about
okay.
whether they can take private insurance and whether that can be claimed similar to what we have in India, because that's a very different topic, right? That is about individual taxation. And if you mix up the two, then you will never be able to understand the difference, from an employer perspective and employee perspective or individual perspective.
Okay, all these facilities are provided by employer, right, to employee.
Yes, correct. Similarly, they have employer retirement plan contribution, similar to what we have as EPF, Employee Provident Fund. That is also excluded. Even we are not taxed on it, right? It is tax free to us. So that is excluded from the employee's taxable income. All right, moving on. Health savings account, again, similar thing. It is tax deductible. Any contributions that you make to this account is tax deductible. Any withdrawals that you make for medical purposes is also tax free. Now, cafeteria plan is very, yeah, someone had a question.
I withdrawals. I mean, can you please what that's?
Yeah, withdrawals could be, see, you might be making contribution to these health savings account on a very recurring basis, monthly, semi yearly or yearly. But there might be instances where you will require money for medical purposes. And there are qualified medical purposes that are laid out, in your textbook or in the IRC, that if you're withdrawing for such purposes, then that amount is tax free in the hands of employee.
Okay.
All right, so cafeteria plan. This is very unique in the US. Now this is, I think, similar to what we have as, if you guys have seen, a lot of companies used to give Sodexo meals, right? Sodexo coupons. If a lot of you are working in
Yes.
corporate.
Yes, yes.
Yes.
Yeah.
PwC is providing Sodexo coupon.
Yeah, so if you guys get these Sodexo coupons, these are a flexible tax advantage strategy that you can take so that you're not taxed on that income, right? It is usually tax free in the hands of you, right? So you will not be taxed on this portion of advantage that is given. So it is very similar in the US that they have a cafeteria plan. So any contribution made to this plan and the amount utilized here can reduce your taxable income. Fringe benefits, these are certain additional advantages or additional benefits given by the employer to the employee. And if they qualify, right, there are certain qualified fringe benefits laid out in your textbook as well. Some examples are like gym memberships provided by the employer. A lot of companies, are promoting health and fitness, so they do provide gym membership. They can be giving free access to certain maybe online portals, yoga portals, online classes, any company cars that are provided, any educational assistance, right? A lot of companies also sponsor EA, CPA, right? So all of these are fringe benefits and these qualify from an IRC perspective, and these are non-taxable in the hands of employee. So if you are receiving these fringe benefits in the US, then you will not be taxed on this portion of the income. Non-taxable fringe benefits, again, these are again certain other fringe benefits that are excluded from employees' taxable income. There are specific examples in your textbook as well. Some of these are transportation benefits, commute to office when you, a lot of companies also provide company cabs. So these are not taxable in the hands of employee. Awards. Okay, so some companies do give awards, right? We do have regular recognition and rewards and recognition events that keep happening. So it is mostly taxable. So if you do get, like we do get a lot of quarterly awards in accounting firms. I'm not sure about other type of firms, but in mostly accounting firms, you do get quarterly awards, monthly awards, right? Yearly awards. And mostly those are in some form of either redeemable coupons or in terms of cash that is given, right? So these are mostly taxable unless there are two exceptions to it. It is for the length of service or if it is for safety achievement award. Yeah, length of service is basically when you spend a certain number of years in a firm, right? Some firms do have that. If you spend 5 years, they do give you $50,000 bonus, right? So if it is for length of service and if it is for safety achievement award, then those are not taxable. That can be excluded from your taxable income. Again, they have your non-qualified plan and qualified plan beneath length of service and safety achievement, and they have capping of $400 and $1,600 for it.
What are these qualified plan awards and
Sorry?
what are these qualified and non-qualified plan awards?
So IRC has laid out what criteria falls under, a qualified plan. So when they set up, when a company is sponsoring or providing awards, they can set it up as a qualified plan award as well by meeting certain conditions. If they do meet that condition, then awards up to 1,600 given to an employee can be tax exempt. But if they did not set it up with the IRS in that manner, then only up to $400, awards given would be non-taxable. Anything above and beyond that would be taxable in the hands of employee.
Okay, thank you.
Yeah. All right. So this is the last topic for the day. I know we have a lot to cover in this. So we'll be covering most of the expenses. I think we have about 15 different types of expenses and deductions to cover. So please stay patient with me, and then we'll hopefully wrap this up in the next 30 minutes. I might have to extend this class for another 10 minutes to take up any Q&A, but requesting all of your coordination and patience here. So expenses and deductions, what are the different expenses and deductions that a business can claim or a business entity can claim from an employer perspective? So the first one is your startup and org cost. These are generally capital expenditures that are incurred to set up the firm when you're starting a new business, when you're organizing a new business. These are the costs incurred during that process. And startup costs are usually capitalized and amortized over time, right? It is amortized over 15 years, which is equivalent to 180 months. But now the IRS also has a one-time deduction that they allow. So in the first year, when you incur the startup and org cost, you're able to deduct up to 5,000 of startup and 5,000 of org cost separately on your tax return as one-time deduction. And the remaining expense that you've incurred can be claimed and amortized over 180 months, which is 15 years. There's one exception to that one-time deduction that I spoke about, $5,000 for startup and $5,000 for org cost. Now that if that amount of capital expenditure exceeds $50,000, say when I was setting up a law firm, I spent about $53,000 in startup costs, right? Then that $3,000 cost, that excess of 3,000 above 50,000 has to be reduced from my deduction amount. So let me explain this in an Excel. I think that'll be easy. And this might likely show up on the exam as well. So I just wanted to throw some light here. Let's only talk about one type of expense. It's similar on org cost, but I'm only talking about startup here. Zoom in a bit.
Can you please zoom in?
the Excel.
Yeah. Figure it's very. Is this better?
Yes.
Yes.
Okay, think about it this way. So if you incurred startup cost of about $40,000, right? So what would be the first year deduction?
5,000.
Would it be 5,000? Does everyone agree to that? Let's go back
Yes.
to the slide deck once more. So let's read this together. So you can elect to deduct up to 5,000 of startup and 5,000 of org cost in the initial year. If it exceeds 50,000, then reduce the deduction for each category. So it did not exceed 50,000, we are good. But the next line says, rest of the amount should be amortized over 180 months, beginning with the initial month of operation. And in this case, say we started, let's keep the facts simple. We started in January. So then my first year deduction would be 5,000 plus the amortized cost for this year, right? Amortized cost for year one. So since I started in January, I would say the remaining cost is how much? 40,000 minus the first year deduction that I took based on the advantage given by IRS divided by 180 months times your 12, right? Or I could just do divide by 15. That's much easier since we have a full year. So this would be your total cost that will be deducted on your tax return. Did everyone understand this?
Yes.
Right?
One second, sir. One second.
Let me go for another example. I think it will be much clearer then. Okay, again, we started in January. Our startup cost now is about $52,000. So what will happen here? My first year deduction, would it still be $5,000?
Yes.
No, right? Because
No,
if you read,
50,000 we can claim.
yeah, so if you
It's
read the second
exceeding
bullet point,
50,000.
yeah, if it exceeds $50,000, then you have to reduce the deduction that can be claimed, right? You cannot claim the entire 5,000. So I would say that it is exceeding $2,000, right? So 5,000 minus 2,000. This is the amount that I can claim as first year deduction, and the rest will be amortized again for next 15 years. So 52,000 minus 3,000, which is what I'm doing here, right? And then the remaining gets amortized over 15 years. So this will be my total first year deduction.
So in case it is a 55,000 startup cost,
Yeah.
then first year deduction will be nil, right?
So yes, let's look at that example now. So again, we started our business in January. Our startup cost is now $55,000, right? Like Anil mentioned, it is 55,000. So my first year deduction now will become nil because anything exceeding 50,000 has to be reduced. Now, how much is it exceeding? $5,000. So entire 5,000 is wiped out. I'm not going to get any first year deduction. All of this 55,000 has to be, amortized over next 15 years. So you see, the amortized cost comes down. Then this is obviously to promote smaller firms to take larger deduction. You see, if I'm spending 40,000, obviously I'm going to be a smaller firm when in comparison to a $55,000 firm, right? So smaller firms get most advantage, and as you get bigger, you get less tax advantage. That is how every government sets up its tax strategies, right? If you increase your salary as you go up the higher the rank, you get more salary, but your tax liability also gets bigger. You get less tax advantages. So this is how it is set up.
Yeah.
I have a question. So, in case the cost is like 60,000, our third example still holds good, even if it is
The third
60,000.
example,
Yeah.
the third example holds good. So if you are at 60,000, I'm still not getting any first year deduction because it has obviously exceeded the 5,000 mark, right? It is way and beyond 50,000. Like 10,000 is bigger than 5,000. So I'm not going to get any first year deduction, but the rest can be amortized. So I'm going to get, amortization cost for first year would be $4,000.
Gaurav, what should we call this 7,333, which we get by adding 5,000 and 2,333?
This would be startup cost, your entire startup expenses for the first year.
Okay, got it. Thank you.
Yeah.
Basically the amortization.
Yeah, although this is amortization, but this is, expensed in this year. The rest of it is amortized and shown on your capital account or wherever.
Yeah.
This is hitting your P&L.
Could you please once again show the first example calculation, amortized cost per year? Why you divided by 15?
Because that's exactly the rule, right? It says, IRS says, anything after you get the deduction for 5,000 has to be amortized over 180 months. 180 months is equivalent to 15 years. And since we had one full year, I divided it by 15. Right?
Got it.
Yeah. But the best thing would be to use months here. I didn't go into that calculation because, this could be June, right? You might just get half year benefit. So in that case, obviously 15 will not work. You'll have to use 180 months as an example. All right, I hope that's clear. Same thing applies to org cost, nothing different from startup cost. The second thing, second expense or deduction that a business can claim is business gifts, right? So if any gifts is issued or given to clients or the employees, they are tax deductible up to $25 per recipient per year. Okay. Again, remember that it is per recipient per year. So if there are 500 employees, you can deduct up to 500 into $25 because it is for each recipient. Okay, and it is limited to, the capping is for the entire year. Now, gifts exceeding this limit, what happens if the firm is giving a $50 gift instead of $25? In that case, they're able to deduct up to $25. The rest 25 is non-deductible. Okay. Another thing to note is if they incur cost in packaging, any additional pen, if they're giving you a diary worth $25 and there's another pen worth of $2, right? That $2 also can be deducted as a business gift. This is above and beyond the $25 cap that is given. So any incidental cost up to $4 or less can also be deducted as part of business gift. Is that clear?
Yes.
Got it.
Okay. Rental expenses, obviously, we are all aware. If you're incurring rent expense in terms of office space, workshop, factory, whatever it may be, it is all deductible as part of business expense. Expense on lease property, similarly, if you're leasing an office space, it could be co-works, it could be any other office building, you're able to deduct that as an expense as well. Interest expense, right? Now, this is very critical after TCJA. I would say Tax Cuts and Jobs Act, introduced this new concept of business interest expense capping. I will not go into detail of the calculation on how to do it, but I just wanted to highlight that third bullet point that there's 163J deduction for business interest. But yeah, for interest expense, if you're paying any interest on business loans, it could be on credit cards, that is deductible as business expense. This also includes interest on any mortgages, any loans used to finance business operations. You could be taking it from banks. You could mortgage your, if you own a big equipment, you could be owning your office space, you could mortgage it and get a loan from the bank. Any interest paid on that is also tax deductible. If you see, I've highlighted one thing. If the interest is on debt, if you've secured a loan to produce real property or certain tangible personal property. What is this certain tangible personal property? Can you give me some example of the tangible personal property that I'm talking about under UNICAP rules?
Any vehicle, I think.
No, so if you go back to the
Something linked to the
UNICAP
business.
rules,
Plant and
tangible
machinery.
personal property under
Film,
UNICAP rules
the
is your
film
films,
maker,
recordings,
films, recordings.
videotapes, books, artwork, photographs. All of these are tangible personal property that fall under UNICAP rules. So any loan taken to, for these purposes, that should be capitalized under UNICAP and that cannot be expensed in the same year. So if the interest is on debt to produce real property, like we spoke about production or manufacturing and certain tangible personal property, then that falls under UNICAP rules, which should be capitalized. The last one, the 163J that I was talking about. So what IRS did, in very short, I'm going to explain this. This is a very, very complex thing. Even a lot of people working in accounting firms still find it very difficult. So, but in very simple terms, what happened is when Tax Cuts and Jobs Act was introduced in 2017, they did a capping on the interest expense that could be deducted by a business. So say if you incurred $100 million of business expense, business interest expense, not all of it could be deducted based on certain criteria. They usually have a 30% limit on that interest expense, right? Only 30 million of it probably could be deducted in that first year. Now, what happens to the rest 70 million? It is carried forward indefinitely. So you're able to get that benefit in the future years as long as you have income position. So that was certain, criteria that was brought under TCJA. So just to remember that there's a capping under 163J up to 30%. There's specific formulas. Obviously, it's not flat 30%. There's a specific formula if it exceeds certain amount, all of that. Um, but again, it will not be tested on your exam, so not to worry about it. But just remember that there's a capping under TCJA. Papia, please, can you mute your mic?
Can you explain the cap again?
Yeah, so again, similarly for 163J, when I was talking about, basically after TCJ was launched in 2017, the IRS laid out certain formula where only 30% of your certain amount, right? It is adjusted taxable income. Now, how do you arrive at that adjusted taxable income? There's another formula. You don't have to get into too much of detail, but basically the IRS limited the amount of interest expense that could be deducted in 1 year The rest of the interest expense that you're not able to deduct in that year can be carried forward indefinitely.
It is carried forward for how many years?
Indefinitely.
Okay.
There's no cap on how many years you could carry forward. It is up to how many ever years you carry forward until you utilize that entire amount of interest expense.
One example of it in Excel. Simple.
Again, like I mentioned, you don't have to delve deep into it, but quickly, if I'm just able to explain it without say IRS says only 30% of it can be deducted, only 30 million of that interest expense can be deducted in this year. The rest 70 million can be carried forward for the next future years, and you're able to deduct it in your tax return for future years, as long as you have income in that year. It is only to make sure that businesses are able to stagger their expense, and they're not taking a big expense in one year and bringing down the tax liability to maybe zero or very few dollars. They want to make sure. And if you remember, Tax Cuts and Jobs Act happened to promote economic activity in the US, right? If people or businesses are not paying taxes, then if they're able to take such big expense on their tax return, then they're not going to pay a lot of tax. And if tax is not paid, there's no cash that is going to be pumped in the economy, right? So if they limit that expense, then they're also giving the benefit. They're not saying that you cannot take this expense. You can take it in future years, but for this year, take a smaller expense, pay a little bit of liability so that we are able to generate and boost the economy. Think about it from that perspective. All right. Um, Insurance premiums deductible. Any premium paid for business insurance, it could be for any liability, property insurance, for your office space, all of that is tax deductible. Um, Nothing more there. It's as simple as any expense or premium that is paid for any business purposes that can be tax deductible. Key man life insurance. Now, this is again a very familiar concept in the US. So, what happens is a lot of firms take life insurance for their key employees, right? We spoke about key employees in the first topic when we were talking about employee compensation, right? If they're taking life insurance on certain key employees like the CEO or CFO, then there's no deduction allowed for that, right? Because again, it's going to benefit the company. So the IRS says that you will not get any deduction on the insurance premiums that are paid for your key man people or the key people that you're paying on. But if that employee passes away due to any foreseen circumstance, and if you receive that death benefit, right, then that will be tax free in the hands of employer, right? So imagine, say, one of the big four accounting firm pays premium on life insurance policy for its, say, a CEO, right? Then who is considered a key employee again. Then these premiums will not be deductible as a business expense. Only the death benefit that they receive will be tax free. Self-employed health insurance deduction, these usually are applicable for self-employed individuals. They're able to deduct health insurance premiums on schedule SE on form 1040. This applies more towards individual taxation, but it is covered here because a sole proprietor is again a business, right? Sole proprietorship is considered a business. So you would be filing your schedule SE on your form 1040, and then you would be claiming this health insurance deduction. um, Travel expenses incurred for business purposes, it could be your air tickets, your lodging, meals, all of those are deductible. Obviously it has to be for a business purpose. It has to be maybe could be because you're going to meet your clients, you're going to attend some trainings, conferences, or do any business development meetings. So anything incurred for business purposes can be claimed as a business expense on your tax return. Automobile expenses, again, any expenses related to use of business use of a vehicle. Maybe it could be you're spending it on gas, petrol, maintenance, any depreciation that is incurred on your car. All of these are tax deductible. Now, this can be using two methods. One is your actual expense method. Basically, if you spend $100, you could claim all of that $100, or it could be based on a standard mileage rate. There's a standard mileage rate that the IRS has provided, and you could use that rate. You could look at what is the standard mileage rate for the current period. You could use that rate and deduct based on how many kilometers or how many miles you have spent traveling or commuting to the office. Meals and entertainment. Okay, so this is again critical thing that changed recently. Um, Previously, both meals and entertainment were tax deductible up to 50%. Now, no entertainment expenses are allowed until December 31st, 2025. This is also a step, to boost more money in the economy. They're not giving this tax advantage that you could deduct any entertainment expenses until December 31st, 2025. But business meals, are still generally allowed up to 50% deduction until that year. So no entertainment expenses are allowed anymore. Business meals are still allowed up to 50%. Casualty and theft. Again, expenses related to loss of business property. It could be due to casualty. It could be due to theft. All of these are deductible. Now this could be damage or theft of inventory. It could be your equipment. It could be your laptops. Any other property, business property. All of these are tax deductible. Any taxes paid by the businesses. Now, these could be property taxes, it could be payroll taxes, sales tax. All of these are considered business expenses, and these are also tax deductible. Some other miscellaneous expenses. The list is, pretty big in your textbook. I highlighted some of the key ones that are likely to show up on the exam. So some of these miscellaneous expenses are also tax deductible. Some of those include advertising, internet related expenses, tax preparation fees, right? A lot of clients pay us tax fees to prepare their tax returns as accounting firms. All of that can be deducted on their tax return. So they would be claiming it as tax preparation fees. Um, any penalties for late performance or non-performance of a contract. So probably they entered into a contract with another client, and there might have been a clause that if you do not complete the contract within a certain period, then certain penalties might be levied. So if they do end up in such a situation, then that expense can also be claimed as a business expense. Now, when we've looked at all of these that can be claimed, we also have to look at what cannot be claimed as, a business expense. So bribes, any kickbacks that you get, all of these are not deductible. Any lobbying expenses for political parties, these are also not tax deductible. Entertainment expenses, like I highlighted, right? It is no longer deductible. The rest 50% of your business meals, because if you spoke about meals, only 50% is allowed. What happens to the rest 50%? You do not get any deduction. It's not carried forward like the interest expense that we spoke about 163J. It's not carried forward. The rest 50% gets lapsed in the current year itself. Political contributions, again, not deductible. Any club dues and membership fees, these are also not deductible. All right. Think we are almost at the end of the session. Let me quickly open the chat box
So
and
I have
see if
a
there are any
question.
specific things.
Uh,
Yeah, go
in
ahead.
last slide, we have mentioned that travel expenses is deductible, but before that one, there was one slide. Business travel expenses is not deductible. So could you please explain that point? Yes,
Travel
here
expenses.
it is deductible, but before that, two slides earlier, there was a employee compensation reimbursement. In that slide, it is mentioned as not deductible. Business traveling, yes, business travel.
Where exactly is it listed here?
Uh,
don't see it under employee compensation.
It is related to business traveling, where the employees
No,
traveling.
this is the one I was talking about, right? Employee business expense reimbursement.
Yes.
This was different. This was different, but this is from a employer perspective. Here we are talking about expenses and deductions from an employer perspective. So when if as an employer I'm spending money, whether it could be on my board of directors, whether it could be on certain key employees that are traveling for business meetings, conferences, trainings, then that amount spent, whether it is on airfare, lodging, all of that is tax deductible on the
Okay.
business tax return.
Yes, yes. From employer it is deductible. From employee it is not deductible. Yes.
Yeah, right.
Hello, Gaurav.
Yes.
Yes, today is my first session, so can you guide me the whole thing, like when the exam is conducted, what are the other criteria are required?
Yeah,
What
Papia, for that they do have session. I think Simandhar does host a session separately, walking you through enrolled agent and in its entirety, about prometric, about your PTIN requirement, when the exams are conducted, how do you register for the exam. So I would request you to reach out to one of the spokes on in Simandhar Education and they'll be able to guide you.
Okay, okay. So there is a other portion is there who will guide on the other matters, right?
Yes, correct.
So where to check the recorded session?
Onboarding link share you check. Onboarding link. It's conducted every day.
Swami?
I'm
is
saying onboarding link, you click on that. It is conducted every day, so you will be able to.
Gaurav, can we continue with the refresher? 5 other are there, I guess.
Yeah, we could go over those questions. I think it was helpful. Let me just quickly switch over my screen.
Yeah.
আইসক্রিমটা দেবেন
All right. Are you able to see my screen?
Yes, Gaurav.
Yes.
Okay, let me open the chat box on another screen. All right, let's look at the next question. And this again is from the previous class. So please do not confuse it with the topics that we spoke about today. Okay, so this one says Eric is a cash basis taxpayer. He owned 25% of Watson Inc. stock. Watson Inc. files a calendar year US corporate income tax return form 1120 employing the accrual method of accounting. So again, Eric is an individual who has cash basis method, whereas Watson Inc. is a corporate entity which is following accrual method. Eric loaned Watson Inc. So Eric as an individual provided loan to Watson Inc. for about $100,000 at the beginning of 2001. The accrued interest on this loan was $5,000 as of December 31st, 2001, right? Watson Inc. paid Eric $5,000 in January of 2002. How should, again, you have to read the prompt of the question very carefully. That is crucial, whether you're taking EA, CPA, whichever course, right? The prompt of the question is what makes it very tricky and, difference between passing and non-passing. So read the question. It is asking how should Eric report the interest income and Watson Inc. report the interest income from this transaction? When this question is thrown at you, you should think about Eric. Eric is a cash basis taxpayer. When did he receive cash? 2002, right? From Watson Inc., Watson Inc.'s perspective, it is a accrual method entity, right? So when did it accrue the interest expense? It was in 2001. So the right answer would be that Watson Inc. reports expense in 2001 and Eric reports the income in 2002. Think I'll have to restart. It's not loading. let me go back. But you guys got the concept here, right?
Yes.
Yes.
Okay, great. Let me reload this. I think it was timed out. So this is what we were going to select, and this is absolutely correct. Okay, this is something that I did not cover, but let me see if someone actually went and read through the textbook that I requested. So how can an employer obtain an EIN? EIN is an employer identification number. This is 2 plus 7, 9-digit number that is issued to every employer or every business entity. And it is used on the tax returns, right? It is similar to the TIN that we have, taxpayer identification number in India. So how can an employer obtain an EIN? By calling the IRS if an international applicant, by faxing or mailing a completed form SS4. SS4 is the EIN application form. By applying online at the IRS website, or all of the above. Right, the answer is correct. All of the above is accurate. Now, honestly, when I took up the exam, the first response that I had was selecting, the second option as well, similar to what most of you did. Because when I saw form SS4, I could relate that this is, the EIN application form, but I didn't read through all the answer choices. And that is very crucial as well, because if you read through it, it also has all of the above. And if you think about it, in a lot of cases when there's all of the above, right, you have to read the option choices again to see if any other option might be applicable. Now, if you are an international applicant, you can definitely call up the IRS and request for an EIN. You can also apply it online. So the right answer is all of the above here. All right. The next question says, if a partnership fails to timely pay its employment taxes, from whom can the IRS seek to collect the trust fund recovery penalty? We spoke about it yesterday. Any employee whose taxes were not paid, any of one of the partners, each and every one of the partners, each and every one of the partners, and any other person the IRS determines to be responsible. Some say C, some say D. The right answer is D. Each and every one of the partners and any other person the IRS determines to be responsible. Now, this is specific to a partnership. You can say, you're not clear by the facts that whether it's a general partnership, who should be having the responsibility. But if you read through the answer prompts, the last one is more accurate. It could be, any one specific person the IRS determines to be responsible. And if I can quickly show you guys,
recourse and non-recourse liabilities kind of thing we can look into.
now I was going to show one other thing. So this is the form 1065, the partnership return that we were talking about yesterday. And since this question was about partnership, I just quickly wanted to show you one section here. So if you see on page 4, I guess, page 3 of the tax return, sorry, page 4 of the tax return, there is one section which says designation of partnership representative. And this is usually the GP or the main person who is responsible to handle partnership matters. So his name, his number is listed on this tax return when it goes to the IRS or when it is filed with the IRS. So the IRS usually has one person's contact, for the entire partnership. And this could be the GP, like I said, or an active partner whose information is listed here. So that's why this question is very similar. And if you, when we talk about partnership taxation in the future session, you'll be able to relate to it, that this is actually the right answer, that it could be each and every one of the partners or any other person the IRS determines to be responsible. Yeah. All right. The next question says, Ray owns a delivery truck and delivers bread to retailers locally for the government bakery. He owns his delivery route. In 2001, Ray received a W-2 with gross wages of 30,000 in box 1. Can anyone answer what is a W-2?
W-2 is a wage statement that is received from an employer to the employee.
Employee.
Correct. And when is it filed with the department, and which department is it filed with?
January 31st.
SSA.
SSA, April 15th, I think is the due date.
No, it's not April 15th.
31st Jan.
28th.
Jan 31st.
Jan 31st.
Yes, that's the right answer. January 31st is the right answer, and SSA, Social Security Administration, is where it's filed. Okay, coming back to the question. So he received a W-2 with gross. He received a W-2 with gross wages of 30,000 in box 1. Can everyone mute their mic, please? Thank you. So Ray's federal income tax rate is 15%. For the year 2001, Ray's considered what type of employee and had what amount withheld from federal income tax. So you'll have to think about what is his employee status, whether he's a statutory employee, whether he's a statutory non-employee, an independent contractor, or a regular common employee. And how much of the amount was withheld from his federal income tax. A lot of people say B. Interesting. Any other answers? Gaurav Malik says C. Gaurav, why do you think it is C? Okay. All right. So the right answer is actually C. He is considered to be a statutory employee. And like I mentioned, statutory employees are not subject to the requirement of, federal income tax withholding, right? The employer does not have to withhold federal income tax for statutory employees. Only Social Security and Medicare taxes are supposed to be withheld. Again, if you see, there are following types of employees that are specifically laid out in the textbook. There are 4 types of employees who are considered to be statutory employees, but not common law employees. So a commission agent or driver who delivers beverages, food, laundry, or dry cleaning. And if you see, he owns a delivery truck and delivers bread to retailers locally. He's not working for full time for the government bakery. Although he received a W-2 with gross wages, he's considered by statute or by legally he's considered to be an employee, but from a tax perspective, he does not establish a common employer-employee relationship because government bakery does not have full behavioral or financial control for Ray. So that's why he's considered to be a statutory employee. And since he's a statutory employee, there's no requirement to withhold any federal income tax from the wages of his from these kind of employees. So the right answer would be he's a statutory employee and $0 of federal income tax would be withheld. All right, the last question for the day, and I think we're about 10 minutes over. Davis is a tax preparer. He will have to file a 2001 Form W-2 for which of the following individuals, right? Read through the questions, option choices very carefully. Jana interviewed clients for Davis during 2001 tax season. She only worked during the tax season and was paid an hourly wage against a commission amount. Davis withheld income and FICA taxes from each paycheck. George cleaned Davis's office. George worked for Commercial Cleaners Inc. Shelley lays carpet professionally. She owns her own carpet laying company, Carpets Company. Davis paid her 1,800 for new carpeting in his office. Mackenzie, Davis's attorney, is a member of the law firm Mackenzie and Mackenzie. Davis paid him 12,000 for business legal advice in 2001. Right, I'm very happy that most of them have the right answer, and it is absolutely option A. In this case, this is where you've established an employer-employee relationship because you have the right to control how and why and how and where the services will be provided. Yeah, the method and means of it. So option A is the right answer. All right, guys. I think you guys were pretty active today as well. I hope this refresher session was helpful. If we have to shorten it in the future classes, please do let me know. You can also provide feedback in the Telegram group as well. And then I'm sure there might be some questions that are unanswered. So feel free to put it up in the Telegram group. And then I would request each one of you who are, learning as well to answer those questions. And if some of you are not able to, I will definitely try my best to attempt it as and when I would find time. But then again, we would continue, I guess, next Sunday. And then we'll continue with business taxation in more detail. And then hopefully we can cover a quiz session as well in the same session.
This one is the part one, part two is doing.
Sorry, Papia, your voice was breaking.
The individual taxation is going on, or the part two is going on?
I think part one classes are also being conducted in parallel, but you'll have to contact someone from Simandhar to, get the link for those classes.
Okay, so you are taking only part two.
Yeah, at the moment, I'm just focusing on part two.
Okay, how many chapters are till completed?
We just completed unit 1 or chapter 1 yesterday, which was business entities. Today we were talking about chapter 2, business taxation. It's not fully complete. So next Sunday, I will be focusing on wrapping up the unit 2 as well, along with hopefully a quiz session.
Okay. Gaurav, any other refreshers like you can provide to do as a homework for us, like some practice sessions?
Yeah, I was just about to say, ask the same.
What do you mean by refresher, Shivani?
Like these MCQs which is solved here, like few more for practice at home.
Yeah, it's on the Fast Forward Academy portal. Do you guys have access to it?
But I
No,
guess it is
actually.
not chapter wise.
Okay, all right. I think you should reach out to someone from Simandhar. They should be able to give you access because Fast Forward has a good question bank and then you're able to solve live questions. And I would highly recommend doing it because obviously this is what the exam is, right? MCQs. And the more you solve it, the more you get better at it. So I would
Yeah.
request you reach out to someone from Simandhar and they should be able to help you out.
So are they chapter wise?
Yeah, they are chapter wise and you can select individual topics as well within the same chapter.
Sure. Thank you.
No problem.
Thank you.
Thank you, everyone. Thanks for being great audience. We'll
Thank
see
you
you again
for
next week.
today's session.
Thank you for the great session.
Bye bye.